Hello, everyone. This is Shmorak. Let me turn on my video and say hello to everyone. Happy to see you all here, and thank you for taking the invitation and joining us on this webinar on Deriskifying early stage investments. With me here today is Yossi Konian, which I'll introduce shortly. And we're giving like half a minute longer just for people, as people are still joining the conversation, the webinar. So we'll just give them a few more seconds and we'll begin. So, hi everyone. Let's just start with a quick technical check. Make sure that you can hear me, see me, and see my presentation on Deriskifying early stage investment. If you have any technical issue, please write us in the chat box and we'll try to help you as best I can. Make sure that your connection is okay. So, without further ado, let's begin. So hello everyone, founders and investors. I'm very excited to host this webinar today. My name is Shmorak and I help entrepreneurs save time, money, and heartache in their search for product market fit. Co-hosting this webinar with me is Yossi Konian from Investable Solutions. Now, as a startup, there are two things that you need to get right. First is product market fit, which I will be talking about. The second thing is the right go-to-market plan, which Yossi will be covering. Yossi, you want to say hello and introduce yourself?
So hi everyone, and thank you, Adi. Like Adi said, I'm Yossi Konian from Investable Solutions. The whole concept of this webinar came to life following our conversation Adi and I had a few weeks back about the synergy between go-to-market and product market fit. These are two methodologies and two stages of the startup life that go together constantly. It's not something that you do one time. It's a process that you do using go-to-market, product market fit, new go-to-market, new product market fit, etc., until you zone in on the right strategy to make your startup accelerate. And we were talking about how this comes to play in terms of founders and how it comes to play in terms of investors who do not always necessarily know how to ask the questions to see if these two concepts are available in the startup. So we spoke about it and we decided that, you know, if we can speak about it, maybe someone else wants to hear about it as well. And this is why we have this webinar. I'll give the stage back to Adi, who will start out with his part, which is product market fit.
Thank you, Yossi. So let's start with product market fit. This session, by the way, is recorded, and those that are attending will get the recording, and those that missed it, they will get it as well. So this session will be approximately 20 minutes long, and so will Yossi's session. The last 20 minutes are reserved for questions and answers. So please write down all your questions in the Q&A box, and I promise we will answer all of them at the end. Let's begin. In my 20 minutes, we'll be looking at why startups fail and how it relates to product market fit. We will dig a little deeper into what product market fit actually is and how we can measure it in both B2C and B2B models. We will also be looking at the mindset founders should have to find product market fit. And if we have some time, we'll talk about pivots, which are almost an integral part of the journey to product market fit. As mentioned, after Yossi's session, we will be taking questions, so write them in the Q&A box. Okay, let's start with what product market fit actually is. Finding product market fit means that you have found a good market you can create value for and retain some of that value as profit. It's that simple. It means that the business model works, the unit economics works, and the product works. In some cases, people forget about profit, leaving it out, and we need to avoid it. Think about value as currency. You need to make sure it goes both ways. Make sure you, founders and investors, get value from creating value. So it sounds simple, right? Well, that doesn't explain why 90% of startups fail. Think of all the resources wasted, like time and money, but also the heartbreak for founders and investors. To see if we can avoid this, let's have a look at why startups actually fail. CB Insights lately analyzed postmortem of 101 startup companies. They came up with the top 20 reasons for why they fail. Let's have a look at some of those reasons. So as you can see, I just picked a few and quickly run them by and see if you can see why I specifically chose these 7. Have a close look. Let's have a closer look together. No market need, ran out of cash, pricing or cost issues, users, unfriendly product without a business model, poor marketing, ignoring customers. Now, you may not see the connections yet, but they all relate to product market fit or lack of it. In his book, The Lean Startup, Eric Ries explained the methodology founders need to apply in order to get to product market fit as fast as possible when possible. It's about being customer-centered, driven by assumptions and insights, experimenting with ideas, failing fast, getting back up, gaining speed and momentum. Any one of those above mentioned reasons for failure could have been avoided by applying his suggested methodology. Hopefully, by the end of my presentation, you will see that connection as well. To further explain the importance of product market fit, allow me to use an analogy. To take off from an aircraft carrier, you need runway and you need speed. The longer the runway, the more time you have to accelerate. Now, as a startup, achieving product market fit means that you're at takeoff speed. You're fast enough to take off. That's when you are at product market fit. If you try to grow before you establish product market fit, it means you're not that fast for takeoff and you will plunge to a cold, merciless ocean. Now, bear in mind, funding can buy you more time, but that doesn't guarantee product market fit. If you're moving slow, if you're not accelerating enough, you'll just burn cash slowly, but you will eventually run out of cash. And with no product market fit, there is no chance of taking off. As a founder, your job is to make sure takeoff happens. Make the runway as long as possible by means of raising funds, but never compromise speed, which is what product market fit is all about. If you have any questions, write them in the Q&A, and if it's something for now, or if there's an issue, please write it in the chat box. Moving on. So as an investor, you need to make sure, my apologies. As an investor, you need to make sure founders are on top of this, moving faster and faster. But how do they do that? Let's see. So gaining speed is all about gathering insights. The more you learn about your product, problem, audience, the more you are likely to hit product market fit. Those insights, though, do not seek you out. Using Steve Blank's words, you need to get out of the building to find them. You need to interact with your market and constantly raise assumptions. Assumptions are not facts. You need to test those assumptions with real customers. And each validation leads to more insights and more validation. You can call these experiments, trying to see what works best, what value proposition, what messaging, which audience. You do experiments until you find something that really works. And then you experiment some more. It's actually a process that is never ending. After achieving product market fit, you use the same process to drive growth. Growth hacking as a methodology is very similar in concept. Here is an example. Have you ever noticed that while Facebook rolls out a new version of their app every week or two, there is usually little difference between the versions? Ever wondered why? Well, each version includes multiple experiments that are providing Facebook with those insights, and they already have product market fit. They use these insights to drive growth. Now, as an investor, here is how you can tell if founders are applying this methodology. Founders in the audience, think about these questions that I'm about to show you and see if you can answer them. The first question will really throw off founders who are too confident, those that don't need assumptions. They are certain of everything. When asking about an assumption you are currently validating, a good answer might be something like, we're experimenting with different value propositions to see if we can improve conversions and customer acquisition costs. But asking just about the assumptions that you are currently validating is not enough. You need a follow-up question to make sure that they are not just walking the walk, but are actively seeking to gain insights from this process. If a founder can share a moment he or she was surprised by an insight, it means they are willing to let go of their initial concept. It means they are open to the possibility of being wrong. This is so important because if you are overconfident, you will eventually be wrong, and sooner than you think. If you have questions, shoot them in the Q&A or send us in the chat box. So before we move on to how to measure product market fit, I want to share with you a quote to inspire you to do more experiments. I'll read it out loud because it sounds outrageous. Go and piece away $5 million in experiments. The person who said it is Doug Leon from Sequoia Capital. He told this to Sanjit Biswas, one of the co-founders of Meraki. They make managed routers and they sold to Cisco for $1.2 billion in cash. Now, by the way, when they started out, they were thinking about selling routers to building owners, upgrading the property with internet so they can charge more rent. They didn't stay there, most likely because they had $5 million to piss off on experiments. But whatever they actually spent that amount or not is irrelevant. What's important is the message. Experiment with your product, with your value proposition in order to get the product market fit. So we understand there is a methodology for finding product market fit, which requires running experiments, raising assumptions, validating them, gaining insights, and driving those into your product and business model. We also understand that as investors, it's super critical to find out how likely founders are to find product market fit. We can ask the right questions and see if they are open to the possibility of being wrong. Some founders might even say during a pitch that they don't know something. This doesn't necessarily mean they are sloppy. It might mean they actually don't know, which is something to expect when starting up something new. How to find out is the true test. But other than the team, is there another way to evaluate product market fit? Do metrics and data have anything to do with product market fit? Can we measure product market fit? Again, if you have questions or any kind of issue, please let us know. So I'll be moving on. Turns out that we can. Measuring product market fit differs based on your business model. When operating in B2C model, your main proxy for product market fit is word of mouth. If you achieve organic growth, you are probably on the right path to product market fit. This doesn't mean that the market is good, but that the fit is there. And there are ways to measure it and even take it further. A common way to measure word of mouth is by a proxy called NPS, Net Promoter Score. The concept is simple. You ask your customers how likely are they to recommend your product. If they give you a score of lower than 7, they are detractors. If they give you a 7 or an 8, they are neutral. 9 and 10 means that they are promoters. Your NPS score is the percentage of promoters minus the percentage of detractors. Whatever score you have, as long as it's positive, it's a good sign that you're on your way to product market fit. But during their peak growth, for example, Facebook had an NPS score of -14. So you don't need to take NPS as certainty. It's just a proxy. Another way for you to measure your organic growth is to stop advertising for a while. See if anyone knocks on your door. That might seem a bit extreme, but analyzing your traffic and searching for the organic part of it is another approach you can take to see how much word of mouth there is in your product. Sean Ellis, who drove growth at Dropbox, BitTorrent, and other successful products, was the first to introduce a follow-up question to the Net Promoter Score. By measuring how many of your customers would be very disappointed if they could no longer use the product, Sean found another proxy for product market fit. If over 40% of your users would be very disappointed, you probably have product market fit. But you can actually take this a step further. Sean developed alongside Kissmetrics what is called the PMF Survey Tool, which is free to use and can help you test your product market fit with your customers. The survey includes a few more questions, including what alternative would you be using and what are the main benefits you see in the product. These questions bring insights as to your positioning and value proposition and can help you even prioritize your roadmap. The product market fit survey is a free tool, and I will share the link in a follow-up email. There's an interesting story about how Superhuman, the super fast email client, for those of you who know it, who don't know it, how they found product market fit using this methodology. They surveyed their customers based on Sean Ellis format and used the insights to push well beyond the 40% mark, which is the indicator for product market fit. They found out what customers really loved about their product, which was speed and shortcuts, and made this their value proposition. They focused that on their roadmap. They also were able to zero in on their buyer's persona and seek out more lookalikes, making marketing way more effective, increasing both conversion rates and the percentage of customers who would be very disappointed. Again, if you have questions, just put them in the Q&A box and we'll answer all of them. So that was measuring product market fit for a B2C model, which is fairly simple. But things get a bit more complicated in a B2B model. The reason for it is because the decision maker or buyer is not always the user. And while word of mouth is still relevant, it is not as good as a proxy. Regardless, the two options that I'm going to share with you were suggested by Andy Ratcliffe, who coined the term product market fit. Andy is also a very successful entrepreneur in Silicon Valley, so we should definitely take his word. So let's see how you can still measure product market fit, but in a B2B model. Don't be scared. And again, if you have any questions, put them in the Q&A box. So one way to measure product market fit in a B2B model is to go by the sales yield. This model was developed by Mark Leslie, who created the sales learning curve. In his paper, which was published in Harvard Business Review, Mark suggested that the product market fit is indicated by a sales yield of greater than 1. Now, what is sales yield? It's the total revenue from sales divided by the cost of the sales team. So, say your sales team with overheads and all are costing you $500,000 a year. Once they generate $500,000 a year in sales, you've hit product market fit. You need to remember that at that early stage, your sales rep are not your common sales rep. These agents won't have a playbook to follow by, but they will help you write one. So when sales yield is greater than 1, this is a good indication for product market fit in a B2B model. By the way, when that ratio gets to 2, it's time to hire more sales rep. Give them the playbook that the previous sales rep wrote and see orders coming in. Once everything is in sync and you're fully efficient, you'll get to X4, and that's when you know that you've made it big time. So it's worth investigating or exploring the sales learning curve because it outlines not only the product market fit, but later stages of growth and the sales team growth. But we are now talking on product market fit, so I just gave you a taste of how you can use this even further. So the second option is a bit more extreme. It was suggested by Doug Leone of Sequoia Capital. He suggested that to Andy Ratcliffe. Doug Leone was the guy that said piece of $5 million on experiments. And his idea was basic. Usually when you do a pilot with a customer, there's a time limit, say 30 days, that the customer can evaluate the product and then make a decision whether they buy or not. What Doug suggested is when the trial ends, you pull the plug, no matter what. And if the customer doesn't scream, well, it means you don't have product market fit. It's that simple. It's extreme, but simple. The reaction that you want to get from a customer that you're pulling the plug on is shut up and take my money. Anything else, and you don't have product market fit. So we have a few more minutes that I want to focus on two smaller things that are integral to product market fit. These are assumptions and the pivot. So when making any assumptions, you can be either right or wrong, right? That's the nature of making an assumption. Now, if you're wrong, then there's no viability in whatever assumption you had. But your assumption can also be either in consensus or out of consensus. And when you're right and in consensus, well, you're too late. The market is flooded by competition and you'll be fighting over margins. When you're right, but out of consensus, stakes go up, but things get also very interesting. Think about when Airbnb suggested you spend the night on a stranger's sofa. That was out of consensus. Or think when Uber suggested you take a ride with a stranger driving his private car. That was also out of consensus. We might call it disruptive, but out of consensus is another way to look at it. And when you're making an investment, you take high risks and you need to make sure the opportunities are just as big. And founders need to make assumptions, especially when it's a big business model, value proposition assumption. You need to think a little bit out of consensus if you want to make it big. Okay, so the second thing that I want to mention are pivots. Pivots are an essential part of finding product market fit. It's not failure of finding it. In a way, product market fit is achieved by a series of small incremental pivots. You play with your value proposition, the audience, the product, but you keep your insights. That's your 1 foot nailed down. Now, if you miss on too many insights or don't experiment enough, you reach a dead end. And then a pivot becomes something much bigger. It becomes an event. But regardless, pivots are not a bad thing. Do as many as you can, as often as you can. Keep them small, unnoticeable when possible. It may sound counterintuitive, but being that responsive to your audience will help you achieve product market fit faster. Thank you for listening for this part. I hope it was insightful. If you have questions regarding product market fit, please send them through the Q&A box and I'll answer them all. Now that you have found product market fit, it's time to talk about your go-to market plans. Yossi, are you ready?